Hello everyone. My name is Kamal Manocha. I represent PMS AIF World. In the rhythm of doing webinars every Friday, we have another very interesting and very unique webinar for all of you today. We have been hearing a lot over last, I would say 3 years especially about micro, management in terms of portfolio management, where the emphasis is put primarily on businesses, and all these businesses are held with great conviction that eventually moated businesses will perform. However, what we have seen over last 3 years, where we saw worldwide pandemic kind of an event happening, or over last almost 1 year, interest rates coming up from Federal Reserve rates, closer to zero to almost closer to 5%. All this has led to very, I would say, different perspective on various sectors, various types of businesses. Growth types of businesses were popular maybe 2 years ago, and now again we are back to value style of investing. Those portfolio managers who have always been kind of proponent of ignoring macros and only focusing on micros have actually underperformed very badly. But again, this has given us also learnings, and that is where we discovered Mr. Amit Goel, who represents Pace 360 degrees, and his area of forte and his area of specialization primarily is macros, which is basically that we call as top-down approach. He brings with him 26 years of experience, and he's a co-founder and chief global strategist at Pace Group, which actually got established in India in financial services in 1995. Over last 26 years, he has been managing and advising on proprietary and client investments across all financial assets in both developed and emerging markets. And today we want to hear from him his perspective on what are the opportunities and challenges in context of current economic environment, because we have been seeing over last almost 2 decades equity markets have been testing patience. It has not been seen, I think, in my career of last 2 decades, equity markets testing patience for so long. We saw global financial crisis in 2008, which lasted almost 1 year. Then COVID crisis lasted just 4 or 5 months. But the crisis which is currently going on has not given much pain in terms of falling in stock prices, but at the same time it is testing patience because broader markets have been correcting, and it's all, I think, to do with we all missing macros. And that is where it is important to understand what are the signals of the macros in the current context. And hence this entire presentation, this entire webinar is focused on this particular aspect, which, as per Amit, who is today's speaker with us, is maybe a smaller area of business in current context in Indian equity markets, but is a huge potential. More and more products will be manufactured as more and more realizations will be kind of had in terms of the importance of understanding macros. So that's hence the topic for today's webinar. Welcome, Amit, to this platform PMSAIF World. We have been doing these webinars to discover fund managers like you and also build our conviction, and hence based on our conviction offer these products to our clients. We do quality risk consistency analysis. So while we'll be kind of listening to you, we'll also be evaluating you from the point of view of offering you as one of the portfolio managers to our clients. And good luck to you for today's webinar. And if you want to kind of begin the webinar by introducing yourself formally again, you can do that. Otherwise, we can start with the presentation. Over to you.
Thank you so much, Kamalji. So a very warm welcome from Pace 360 to all our viewers and audience from all across the world. So Pace Group was, of course, started by my brother and myself way back in 95, and we've been in the securities and investment business for all this while. And we practically started our macro top-down research from the day we started our business. So I have been personally doing macro top-down research for the last 27 and a half years. And whatever I'm going to present to you guys today is, in effect, culmination of what we have gained, what we have understood, and the knowledge that we've acquired over the last 27 and a half years. So macro top-down is, it's a completely different world. Globally, of course, macro top-down is worth trillions of dollars. But in India, so far, it does not have a huge market share of the total financial market of asset management that we have in the country. But I can assure you that this aspect of the markets is growing at the fastest clip even now, And I can assure you that over the next 10 years, this is going to explode. This is going to go exponentially. And just like there are so many trends which start in the West and finally, sooner or later, they come down to countries like India, we believe that this trend has already started in India now. We have been a little late in the cycle when it comes to macro top down. But I can assure you that over the next 10 years, people will discover this type of asset management, the unique features that it has, and the advantages which it carries over the traditional micro bottoms up approach. So I start with the presentation now. Yeah. Right.
Sure, Amit. So while you begin your presentation, I would want you to first kind of give a context on what has been the performance of various asset classes worldwide, and if compare that to say in India also, and what do we attribute to that performance differentiation?
Sure. Uh, so basically, of course, last 12 to 13 years, ever since the bottom of the great financial crisis happened in 2008-9, we all know that the kind of wealth creation that has happened in equities has been unprecedented. So the only phase in last 200 years when we had these kind of, with this kind of appreciation in equities and this kind of value creation was either the preceding years of the tech bubble of 2000 or the preceding years of the Great Depression of 1929. So last 12 to 13 years in some ways has been as magical as the roaring 20s or the roaring 90s. And equity as an asset class has done, of course, extremely well. And fixed income has not done well in this period. Even asset classes like gold have largely underperformed. But over the last, of course, 1 to 2 years, we started noticing this trend when equities have started underperforming. And you can see a trend that a lot of equities have found their, let's say, close to their saturation value, and the equities are no longer behaving the way they behaved from 2009 to, let's say, 2021. So of course we'll be covering the relative returns of various asset classes in more detail later on. But what I can start with what exactly is macro top down investing. So as you can see on the screen, macro top-down investing starts from the top and then goes to the bottom. It starts from GDP, interest rates, inflation, bond spreads, real estate values. This is where it starts from. And then, of course, there are a host of things that we study. We study the fund flows from one part of the global markets to another part. Then we study all the economic data that comes from all over the world every single day, whether it is Asia or it is Europe or it is US. Then, of course, we study the geopolitical factors, which, of course, is extremely important for our analysis. We study the technological and the scientific trends, because we all know that the bull runs in equities are often based on the changes in technology that happen. So what would be the 90s like had it not been for the internet and the telecommunication revolution? And what would be the 2010s like without the amazing evolution of e-commerce and smartphones and social media, digital media, right? So we follow these trends very closely. Then we follow the anthropological trends, wherein how is the society evolving, how are the what are the spending patterns changing, what are the lifestyles changing like all over the world. We look at behavioral finance, we look at liquidity and fund flows coming from the central banks of the world. And then we look at whole host of sentiment indicators. Where are people optimistic? On which asset class people are pessimistic? And then, so it's an amalgamation of these multiple streams. And based on this, we are then able to decide which are the best asset classes for our investors. This is how we start. And then, of course, we go down. Then the next stage is identifying the individual asset classes and individual countries which are likely to outperform. Then the next stage is when we identify the sectors and the industries which are likely to outperform. And the last stage, of course, is identifying individual company stocks and bonds where we would want to invest our money. So this is what macro top down is like. So these are some of the reasons why we believe that macro top down has now come of age, and you would see a parabolic rise in the quantum of asset management by the macro top down players. And this is one area of the Indian financial markets which has not yet caught up with the world. But I can assure you, I can bet my last dime on this, that this is going to catch up big time over the next 5 to 10 years. And here are the reasons why. So macro top down is able to generate returns across bull and bear markets. So your micro bottoms up will generate money over the bull markets, but would severely underperform and give negative returns during the bear markets. But macro top down would generate returns across bull and bear markets. Extremely low volatility and standard deviation, because we avoid the greed and fear. We avoid the boom and bust cycles across industries, because of which the volatility is very, very low. It's almost like that of a short-term debt fund. That's the kind of volatility we've enjoyed over the last so many years. So the risk-adjusted returns are obviously very high because the absolute returns are very high. And because low volatility and standard deviation, the risk-adjusted returns are even higher. And the Sharpe and Trenor ratios are extremely high compared to the rest of the industry. We give uncorrelated returns compared to your rest of the asset classes. So our returns are completely uncorrelated with the returns generated by the bottoms up guys, whether it is mutual funds or insurance or AIFs or PMS. And it is very uncorrelated with the performance of any single asset class, because we are riding on different asset classes at different points of time. So we would be extremely equity overweight at some points. For example, post-COVID, we were extremely overweight on equities. But then in the last 1.5 years, we've been rather underweight on equities, and we become more opportunistic. So because of these factors, we provide uncorrelated returns, which means that we provide a great hedge, a great diversification opportunity for anybody who has invested a lot of money into equities or into equity mutual funds or whatever. So the next point is that in sideways to volatile markets, we do extremely well. That's the time when the micro bottoms up guys are not able to generate any returns, but macro top down can still continue to generate your double digit returns, 14, 15, 16% per annum. So that's where we get amazing alpha compared to the benchmarks and compared to our bottoms up peers. We believe that the next 4 to 5 years are in particular, they are going to be extremely great for macro top down, which is because of the fact that we've had a glorious equities phase over the last 10, 12 to 13 years. And whenever that has happened in the past, in last 200, 300 years, equity markets tend to underperform. So there is a 95% probability that equity markets for the next many years are going to be either sideways or very volatile, or going to be bearish, or going to be only mildly bullish. Now, in each of these four scenarios, which in my opinion is probably the probability for these scenarios is 95%. So macro top down is going to beat hands down every other theme of asset management, and particularly the micro bottoms up. And last but not the least, this is a very important point, guys, that over a period of time, as the markets become institutionalized and you have a lot of institutional money coming into the markets, whether it is mutual funds or it is insurance or it is sovereign funds or it is AIFs or it is PMS or it is pension money, provident fund money, as the markets become more institutional and as the markets become more liquid, the nature of the market moves from micro to macro. So we were a very micro driven market for about, let's say, 20 years back. But over the last 20 years, because of the institutionalization of the markets and because of the Indian market being one of the most liquid markets in the world, today we are a very, very macro oriented market. And we believe that this trend is not going to change. So this is a permanent change in the markets. And going forward, you would see the markets becoming more macro and even more institutional, which is a very, very fertile ground for a macro top-down fund manager like ours. So this is, again, who Pace 360 is. So Pace 360 is the asset and the wealth management arm of Pace Group, which has been in business for 28 years. And we have been investing and trading in the global and Indian markets For the last 28 years, we've covered all major developed markets and all major emerging markets of the world. We cover about 60 to 70 countries of the world very actively, where we invest and trade our money and our clients' money. And we've been doing that for many decades now. We are pioneers of macro top down in India. We started way back 27 years back, when we were in uncharted territories and most of the people did not even know what macro top down is. That's when we started way back. Of course, we've come a long way, and markets are also in the process of now accepting macro top down as a very, very major, or maybe even a better alternative to the micro bottoms up strategies. And we, of course, by far, we have been the best performing asset management company in the PMS and AIF category for the, consistently now for some time. And this is again all because of the macro top down strategy. And because we are the industry leaders, obviously, whenever macro top down strategy does well, as it has been doing, and as it is likely to do over the next 5 to 10 years, we would probably disproportionately, we would gain thanks to that. So this is a very important part of the presentation, where we would see how the global liquidity and the global money supply coming from the central banks, how does that impact the global equities and consequently the Indian equities as well. So you can see from these charts, how the global money supply has been moving over the last many years. So you can see that the global money supply was relatively benign for the last many years, but last 1.5 years, this has become brutal. So this has gone completely against the risk on asset classes like equities and industrial commodities. So the money supply has actually been coming down, and in US, the money supply is actually in the negative, which means that year on year, we now have a lower money supply in US measured by M2 than we had a year back. Now, this is unprecedented. And as you can see from the second chart, in the last 100 years, this has happened only thrice. And the global economy and all the economies of the world, they are very closely intertwined with the global liquidity that you have in the system. And as the global liquidity shrinks or goes down or goes in the negative growth rate, you can be very sure that sooner or later you would see the economic growth slowing down, and you could even see potentially a recession. So this is what the situation is as of now. So this is the correlation that you can, you can very well appreciate from the screen, how the S&P 500, and consequently not just S&P 500, but practically all the global equities, including India, you can see how when the liquidity was going up post-COVID, the markets were going up in tandem. And then as the liquidity came down, the markets came down in tandem. And in fact, the last 6 months, which have been very good for global equities. So global equities bottomed out in October of 2022. And the last 6 months have been extremely good. And you can see that the liquidity thing kind of made its interim bottom 6 months back. And that came up, because of which the global equities have also come up. But in our opinion, this is just a correction to the huge fall down in global liquidity between 2021 and 22. And we believe that the global liquidity is again going to start coming down very, very soon. So this is from the, so we've discussed how the global liquidity and the money supply affects the global economy, and it affects the global risk assets, particularly the global equities. That is a statement of fact. It is not really a statement of opinion. Now we come to the, to some of the signs that we are catching from the credit and the bond markets, and what are they conveying for the different asset classes all over the world. So you can see that over the last 20 years, out of the total credit in the system, in the global financial system, the share of small banks has gone up a lot. And this is particularly true of United States. But if you look at the left-hand chart, which provides the overall credit provided by non-banks. So non-banks would include NBFCs, it would include mutual funds, it would include every player, even insurance companies who are not in the banking sector. So they also provide credit to corporates and to the government. So if you see the OECD world, then the credit from the non-banks, which was much lower till about let's say about 20 years back, that has been steadily climbing up. And if you look at the share of small bank loans in US, that has been steadily growing over the last 30-35 years, which is why the recent global banking crisis, particularly the US banking crisis, which was triggered by the Silicon Valley Bank, this has become so much more important because it was a small bank. The effect of that is disproportionately felt among the small banks and even among the non-banks. And that is the part of the global corporate credit system which has got severely impacted because of the outbreak of the banking crisis in US. So we can clearly see that the credit crunch has started. This is no longer just a theory. This is actually visible in the graphs. So you can see that the global credit flows have been coming down. The global credit flow index has been coming down over the last couple of years. And this trend has even got further accentuated over the last couple of months, ever since the US banking crisis started. So this is, in our opinion, a very big negative for the functioning of the global economy. So credit is like the oil which sort of makes the entire global capitalistic system run. And when you have less of this oil lubricating the global economy, then you can be sure that this would have implications on global economic growth and also the global risk assets over a period of time. It does not necessarily happen exactly when it strikes, but it happens over a period of time. And similarly, from the other chart, you can see that how the lending standards from banks and even the non-banks, they have been going up. So that they have been tightening, which means that the banks are no longer as comfortable in giving loans to individuals and businesses than they were, let's say, as compared to the situation about a year and a half back. So the lending standards have been tightening, which means that you will have lesser credit in the system and not more credit in the system. And the rally between 2020 and 2021, the economic boom that happened during that time, it was also a function of the credit, which was moving around so fast in the global economic system, and which led to this massive boom and, of course, the equity markets going up. So here you can see that the bond spreads have started to go up. You can see that every time there is a recession, you can see that the bond spreads have gone up, the default rates have gone up. And similarly, this time also we can see that the bond spreads have gone up. There is an uptick even in the default rates in the US. That is a harbinger of the times to come. So, of course, if the actual recession strikes, you can expect that the spreads will go up a lot more, and the default rates, unfortunately, will also go up a lot more. And similarly, the other chart gives you a perspective as to what has happened over the last 20 years. We saw a huge rise in bond spreads, at the time of the great financial crisis. And to a lesser extent, that happened even when COVID struck. This has now started happening again in 2022-23. And you can expect this trend to further continue over the next 6 months to 12 months and maybe even beyond. So here is one very important picture that we would want to come across with. So the yield curves, this is true of US, but it is also true of many other parts of the world. For the sake of convenience, we are using the US charts as of now, but this clearly shows that the yield spreads, which means that the 10-year bond yield today is much lower than the 3-month bond yield, guys. And the 10-year bond yield is in turn much lower than the 2-year bond yield. So when the yield curve is not inverted, when it is an upward sloping yield curve, which means that the short tenor interest rates are less than the longer tenor interest rates, that is considered a positive sign for the economy. But this yield curve has inverted, and in fact, this is the worst inversion in the last 40 years. And there is a macroeconomic indicator which basically builds on these negative, the downward sloping yield curves, and that indicator, as you can see in the chart, is suggesting that there is a 57% probability of a recession happening in US. And this is coming from the New York Fed, which is a government authority. So they are suggesting that the probability of a recession in US is today more than at any point of time in the last 40 years. So, which makes us believe, and this is, of course, one of the many, many thousands of indicators that we actually watch and analyze, but many of those indicators are pointing towards the same thing, that the probability of a US led recession all over the world is now a base case scenario for most of the economists and for many of the top fund managers of the world today. So this is again a beautiful chart which tells you how the system has reached a breaking point. So the US the plumbing of their financial and the economic system that they have is now not in line with the short-term interest rates that you have in US. So the short-term interest rates, the Fed funds rate is in US is 4.88%. And this is in a way far beyond and far higher than the interest rate which the US economy can sustain if it has to grow over a period of time. And this is a very, very important indicator. So the US banks are sitting on a 19 trillion deposit base. The short-term rates have gone up so much. If they start giving to their deposit holders a rate of interest which is similar to the Fed funds rate, then the US banking system is almost going to be bankrupted. So $969 billion of money is going to flow out of the bank's bottom line and go to the deposit holders. $969 billion. And this amount is actually higher than their actual interest income, which means that they will have a huge negative interest income, and they are going to be, many of the banks are going to be bankrupted. So this is how unsustainable this Fed funds rate is. And if this Fed funds rate stays here for an extended period of time or goes up even higher, then you can be very, very sure that this will have huge ramifications for the US economy, for the global economy, and for global risk assets anywhere in the world. So this is the picture of US real interest rates. And so we've got 5-year real interest rates, 10-year, 7-year, 20-year, 30-year. So, but what we can see from the chart is that in 2021-22, when there was such an amazing economic boom post-COVID, and when the equity markets were at their all-time highs in almost all parts of the world, that time the real interest rates in US were the lowest ever. And now you can see that those same real interest rates are now at the highest of last 10 years. So when the real rates go up, it becomes difficult for the corporates to justify the same projects, because their need of as the cost of capital goes up, then their IRR requirement also goes up. So the capital expenditure, the new business startups, they go down when the money becomes more expensive, which is exactly what has happened over the last 1.5 years. This will have a severe impact on the US and the global economic activity. And obviously through that route, it will have an impact on business spending. It will have an impact even on the consumer spending, because it has become so much more difficult to buy a car or a house today because of the high real interest rates and the high nominal interest rates. So the money has become more expensive. The economic activity in many parts of US and in parts of the world has started shrinking because of the high real interest rates. And of course, this is also having an impact on the global risk assets. So these are some of the leading indicators which we see in the markets all over the world. And again, a very, very interesting study. So these indicators are by no means, they are not very comprehensive, because we look at literally about 1,000 different indicators to arrive at our asset allocation matrix. But some of the important indicators we are covering in this presentation, just to give a flavor of how macro top down works. So, hedge funds have never been more short on US long term treasuries. This is the biggest short position which they have, which they are into as we speak. Now, in our opinion, so this has often been a contrarian indicator when hedge funds have been excessively short in an asset class, and that asset class could be anything. Usually we've seen that that asset class starts to outperform, which is of course our base case as well, that the bonds are going to outperform after being bloodied for the last 2 years. And this indicator is also pretty suggestive of that the bonds are going to outperform, and a lot of these hedge funds are eventually going to be in a stampede to cover their shorts in US long-term treasuries. And please do bear in mind that the US long-term treasuries have a major bearing on government bond yields in any part of the world, including India. So if the US bond yields are going up, you would see the Indian bond yields going up. If the US bond yields are coming down, you would see the Indian bond yields coming down, and similarly for the rest of the world. So, China, of course, is one of the most important parts of the global economy today, thanks to the huge share which they have in global GDP. And of course, it's the largest factory base in the world. They are the largest manufacturing setup in the world today, the largest manufacturing ecosystem in the world. So here what we are noting is that just like it is becoming more difficult for corporates to borrow from the banks and the non-banks as well, here we can see that it has become difficult even for the emerging economies to borrow from the corporate world and the banks. It has become more and more difficult. And because of that, a lot of this borrowing is now happening at a bilateral level. The number of emerging economies today in trouble and close to bankruptcy is higher than at any point of time in last 12-14 years, guys. So here you can see that the rescue financing from China has soared. Of course, a lot of that is also because of their own Belt and Road Initiative, which sort of imposed huge amount of debt on many of these African and South American countries. They are not in a position to pay back their debt, and because of that, now there are more of these rescue deals happening. But fact of the matter is that the window for these emerging countries to get funding, liberal funding from institutions, from banks, and from other creditors, has become more difficult, which is why many of these countries have to go to China for bilateral help, and they have to go to IMF for assistance. And you know that a lot of countries today, including Egypt, including Tunisia, of course, some of our immediate neighbors, many of the African countries like Ghana, like Zambia, many of them are in the same boat. This is also a negative sign for the global economy and a negative report card for the global credit. So this is, many of you would probably find this metrics a little strange, because it's comparing the Singapore electronic exports to the developed countries' earning per share. So, this is just to give you a flavor as to how, complex sometimes macro top down can become, because we would literally be finding correlation and regression between two very, very different parts of the global economy and two different parts of the financial markets. So, we have, for example, you would find it almost funny that the price of bananas in South America could be linked to the price of an automobile in Japan. It sounds crazy, but this is the world of macro top down. And, we have seen how macro top down has been such an amazing success in the West. And hopefully that's going to happen to India as well. So you can see that the Singapore electronic exports, they have plummeted in the last 1 year or so. And whenever that has happened in the last 20 years, it has got correlated with the fall in the earning per share from the developed markets like US, UK, and Western Europe, and even Japan. And we believe that this is again a sort of a leading indicator for us. Singapore exports of electronics have already come down. The EPS has just started to come down, but this is a leading indicator. So this tells us that in the time to come, the earning per share is going to be under pressure, and the profits of the corporates are actually going to come down in the developed markets. So this is again a very, very important indicator. So market breadth is a very big barometer of the health of the stock market. So in US today, you can see that practically in every major bull phase in the world in the last 20 years, the tech bull run, and then even in the GFC, and before the GFC, and then pre-COVID, the breadth had started becoming narrower and narrower. And this time again, this has completely, I mean, the narrowing of the breadth this time around is the worst that we have seen in a very long time, maybe ever. We've never seen this kind of narrowing of the breadth. So this is one indicator of the breadth. We have hundreds of different breadth indicators in India and globally, but you can see that Nasdaq 100, which is dominated by the FANGMA stocks, is so majorly outperforming Nasdaq Composite, which has got about 3,000 stocks. And in fact, you'd be surprised that the entire year-to-date gains of S&P 500, the entire gains, guys, have come from just the 7 tech companies in US. Can you believe it that S&P 500 has got the biggest companies in the world? 500 companies are there, but 7 individual stocks have contributed to 100% of the entire rally in S&P 500 in the calendar year 2023. So this is how the breadth has narrowed. This is an alarming sign for the equity markets in US and all over the world. And this is also one of the reasons which makes us believe that this current rally, and today we have seen some amazing tops. We have seen the Indian market closing at multi-month high. Today, Nasdaq 100 made a 7-month high on a spot basis. So we believe that this rally, which is in some ways at its crescendo right now, to us, it does not look sustainable. It may continue for a few more days. It may become sideways for a few weeks. But overall, the next big move, this indicator is telling us, is going to be on the way down and not on the way up. So again, a beautiful indicator. So in markets there are, it sounds a little unevolved for anybody to say dumb money, but fact of the matter is that there are pockets of money in the market which is known as smart money. And smart money includes some of the best institutions. Smart money includes the corporate insiders and the company founders. They are all smart money. And dumb money is often leverage money coming from individual traders who take leverage bets on the market and who have an uncanny habit of being long on the market when it's the right time to sell and not the right time to buy, and to be short on the market when the market is close to its bottom. And you can see from this chart, so this covers the all major high lows over the last, let's say, about 2 years. And you can see that when the markets were at their highest, for example, in October, November of 2021, the dumb money confidence was very, very high, which means the people were leveraged on the stock market going up. And you know what happened after that. The markets crashed over the next 6 months. Then in October 22, you can see that the dumb money confidence was at its lowest. That was the best entry point in global equity markets in the last couple of years, guys. And that time, these people were short. Their confidence was at the lowest. And now, yet again, their confidence is extremely high. So this is again a warning signal that going forward, equity markets may not have as much of a bull run as we have seen in the last 6 months, guys. So US house prices, so the mortgage activity in US has come down. The mortgage rates have gone up because of the high Fed funds rate, and because of which the housing prices have started to come down. But we believe that the housing prices have a lot more to come down. So they have fallen only by about 2-3% from their top, and the top was made in 2022. But we believe that this trend is probably going to continue for maybe a couple of years. So housing prices, which is very important for the US economy because a lot of their private wealth is actually based on real estate. So when the house prices come down, then there is a negative wealth effect because of which people spend and invest less, which is why often housing prices and the rest of the economy, they move in tandem. When the housing prices are going up, the economy is also doing well, the equity markets are also going up, and vice versa when the house prices come down. So this is again an important indicator. So US corporate margins have been shrinking, and we've seen this in the past that whenever PPI becomes lower than CPI, so whenever there is a switch, so from PPI being higher than CPI, when it becomes lower than CPI, it has always coincided with shrinkage in US corporate profit margins. And as you can see from the other chart, the US profit share, corporate profit share as a percentage of the GDP is close to its highest ever. This is highest ever. And the share of the labor, the wages as a percentage of the GDP is close to its all-time low. Now, this situation, in our opinion, is not sustainable. The profitability of the corporates, the profit margins are way too high, but this has already started coming down in the last 1 year. And we believe that this is going to go a long, long way down. So corporate margins are going to probably go down maybe by about 15 to 20% from these very, very elevated levels. They would still remain elevated compared to historical standards, but compared to the situation a year back or maybe even now, it's going to be probably much worse for the corporate world. This is true of US, and this is true of most of the parts of the world. So wage growth is too high across quartiles. As you can see that just before the tech bubble burst of 2000, 2001, that time the wage growth was very high, and it plummeted when the tech bull run gave way to the tech bust. And then again, pre-GFC, at the height of the housing and subprime boom in US, we saw the wage rates going up for the lowest quartile and for the highest quartile. And the same trend we have seen in the last 1.5 years. In fact, it is a lot more accentuated this time than it has been in the last 20, 30 years. So this tells us that these wage levels are unsustainable. This wage rise is unsustainable in US and similarly in other parts of the world. And when wages come down, this leads to lower consumption spending, lower consumer spending in the economy. And it has a whole spiral which starts from lower wages and it goes on to giving way to an economic slowdown. So we believe that that is going to happen. So this indicator tells us that the expected growth rate in the US corporate profits is still too high. This is, the projections are still way too rosy, and these projections probably are not going to be true, and the US corporate earnings are not going to be going up. Rather, they are either plateauing or maybe even coming down. We've seen some previous indicators also suggesting that. So what this indicator is telling you is that on one hand, the earning projections are still too rosy, and on the other hand, the equity risk premium is still very, very low. In fact, it is still in the negative. Every time there is a recession and every time there is a bear market, the equity risk premium shoots up. And we have seen that time and time again. So this is, of course, just this 8-year chart, but we've been tracking this for a very, very long time. So you know what happened in COVID, the equity risk premium shot up. And similarly in 2018, when the equity markets fell very sharply, there also the equity risk premium went up a lot. and equity risk premium has started going up from very, very low levels, but in our opinion, it has a lot more way to go up. So this indicator tells us that the leading economic indicators in US, they are suggesting a recession is going to happen. This is a bunch of economic indicators which include a whole host of economic data that keeps coming out in US on a daily basis. This indicator has plummeted in the last 1.5 years. This is a leading indicator because it's called leading indicator because it tells us how the economy is going to do over the next 6 months to 1 year. This is at its lowest since COVID crisis, and we believe that this is portending to an economy which is going to slow down. And the worst part of this is that in the last 40 years, it is happening for the first time that the leading economic indicators are so deeply in the negative, and yet you have Fed hiking rates. This has never happened in the last 40 years. Every time the US leading indicators have come so down, you can see from all the previous cycles of last 40 years, Fed has started cutting rates. But right now, the Fed is still in the process of hiking rates. So this just compounds the problem. On one hand, the economic data is suggestive of an economic downturn, and the Fed is raising rates, which means that Fed is going to cause the economy to shrink even more. So the next 1 year is not looking great for the US economy and again, the global economy as well. So we've come to the end of the leading indicators. So this is, we of course watch this very closely, and this tells us how are the asset classes valued at this point of time, and how does that compare to the recent and distant history. So you can see that this is what has happened in the last 10 years, guys. So there has been some amazing wealth creation. Look at Bitcoin, look at Tesla, Apple, Microsoft, Amazon, Google, NASDAQ, even Sensex has delivered 240% of total returns in 10 years, which is fantastic. S&P 500 at 157%, and your gold has given 37%. This is because this is a 10-year picture, guys. If you look at the last 12-year picture, then gold is practically zero return, because 12 years back it made its top, and even now the price is very close to the top that it made that time. So gold has given no returns in the last 12 years, but it has given about 37% returns in the last 10 years, sorry. And bonds have given a negative return in 10 years. This is a huge development, guys. Bonds, after having given great returns in 90s and 2010s, have completely been capital destroyers over the last 10 years. But we are very, very confident that this is going to change. In fact, it has already changed in 2023 so far, and you would see more of that to come. Bonds will make up for the losses that they have generated in the last 10 years, guys. So this is a very interesting indicator. This goes back to 160 years of US history since the US Civil War. And you can see that the number of hours that are needed to buy 1 unit of S&P 500, which was for almost 100 years, you can see it was in a range. And it took off when the bull market of 1980 started, and right now this is close to its highest ever. So now it would need more than 100 hours of work to buy 1 unit of S&P 500, and of course the wages have come up over a period of time. So this tells you how expensive the equity markets are relative to the wages. So this tells us that gold, even though it has gone up in the last 1 year, but it has a lot more way to go up, guys. So gold versus S&P 500 is still close to its lowest. It has come up from the bottom levels, but it is still very, very low by historical standards. And you would see this going up. And probably there are multiple ways that this ratio can go up. But my sweet spot would be that gold goes up and S&P 500 comes down. So both numerator and denominator cause this ratio to go up. And we believe that's going to happen. And here is a leading indicator when it comes to that. So this indicator says that when 70% of the US yield curve is now inverse and coming down, so it's a negative sloping US yield curve, when 70% of the graph is inverted, that is when gold begins to outperform S&P 500. Right now, we are just 6 months since the time when 70% of the yield curve became negative and inverse, guys. And this move of gold versus S&P 500 has started in the last 6 months, but going by history, going by all previous recessions and bull runs in the last 100 years, this ratio has a lot more to go up over the next 1 to 2 years. This is what the government bonds have done all over the world. So 2022 was a complete disaster for government bonds, and they have given the worst returns in ever since 1865. So the worst returns in probably 155, 160 years. This is a very, very rare phenomenon, guys. And we believe that bonds are now going to make up for this huge negative returns which they have delivered over the last 2 years. You can see that apart from the World War II time, there has never been a time when bonds have given negative returns for 3 consecutive years. And whenever they have given negative returns for 2 consecutive years, the returns in bonds has shot up after that. This is probably going to happen this time around as well. And this has already started happening over the last few months, as you can see from the bond prices in India, in US, in UK, in Germany, and in most of the parts of the world. So this indicator suggests that US stocks are not only very expensive, but they are probably in bubble territory. It goes back to 150 years. And so if you draw this uptrending line of US equities for the last 150 years, that line is way below the level right now. So we are so much more elevated compared to that trend of last 150 years. And whenever in the last 100 odd years you would see we've gone above the trend, we have come down crashing below the trend. Every single time this has happened. And if this were to happen this time, S&P 500 would need to come down by 50%, guys. I do not want to sound alarmist, but this indicator is telling you that if US equities and consequently the global equities, if they have to fall in line with the trend of last 150 years, then US stocks need to come down by 50%. You can just imagine what would happen to the rest of the world if that were to happen. So now we come to our findings and conclusions. So this chart tells you that when the recession is slightly longer in duration, when it is more than 12 months, you would see deeper cuts in equities on an average. It's not the rule every time. There are exceptions, but this is what by and large does happen. And since our base case is that of a recession, a protracted recession, which may last for 3 years maybe, so this bear market, this indicator is suggesting is also going to be deep. It's not going to be a shallow bear market, and it's probably not going to be a blink and you miss it kind of a bear market. This could be a protracted affair, and this could be a deep affair. This is what all the tea leaves and all the macroeconomic indicators are suggesting. Of course, we are talking probabilities. We are not talking 100%, but this is our base case. In the most optimistic scenario, maybe we can manage with a subpar economic growth in all parts of the world, and we do not go into a deep recession or a protracted one. But that is the optimistic scenario. The base case still is suggestive that the recession is going to be protracted. So this is what happens, when you are committed to a long-only equity bottoms-up strategy, which many of our viewers, I'm sure, are. So these are the kind of drawdowns that you can expect, when you hit a rough patch, guys. And this has happened in the last 100 years many times. So in 1929, the real drawdown, inflation adjusted basis, the real drawdown in S&P 500 was 82%. It took 25 years to get your money whole on a real basis. In 1968, there was no Great Depression. In fact, there was no severe recession also. But it took 24 years to make up your $1 that you invested on a real basis in equities in 1968. In 2000, it took 15 years. And I'm sure most of you were in the markets that time, and you would remember what happened in 2000 and subsequently. In 2007 GFC, it took 6 years. The drawdown was 53%. Now we believe that the global bear market has already started in 2022. So it is to be seen what is the extent of the drawdown and how much time it takes for $1 or 1 rupee to be invested at the peak for you to recover that 1 rupee or $1 or €1 back. How much time it's going to take? That's a question mark. And but please do bear in mind that there have been times when it has taken even more than 20 years just to be able to recover your money, which is where macro top down becomes so handy, because it would give you returns all throughout these bear market, guys. So all these 25 years or 24 years that it would take for the bottoms up guys to get your money whole, the macro top down guys would probably deliver money to you every single year of those 24 or 25 years. So this is the Indian context. So if you look at Nifty's P ratio, we are right now at about 20. So we are at the average of, let's say, last about 20 odd years. But fact of the matter is that every time there has been a bear market in Indian equities and we've made a bottom, we've never made a bottom at a P ratio of 20. So the highest P ratio significant bottom that we made was post-COVID when we were about 17. But otherwise, this could go all the way down to 15, 14, or even 10, which happened in GFC. So 20 P ratio is lower than what we had immediately after COVID, but this is still way too high a point for the equity markets to bottom. Now we come to the last slide, which tells us about the base case scenario that we have. So we are looking at a low grade but protracted global recession, maybe about 3 years, but we are not looking at a very severe recession right now. So we are not looking at things like what happened in COVID. We were down like 10-15% in GDP, but it was a very, very short recession. It just lasted a few months. So this is going to be a long recession in our opinion, but it's not looking like a very severe recession. Subpar growth rate in India. So our trend growth is now probably at about 5%. So we believe that over the next 3 to 4 years, our actual growth rate will be probably below that 5% because the world is going to be in a slowdown. And every time the world has gone into a slowdown, our growth rate has always got impacted, even though we did not go into the negative. So this is what happened in GFC. This is what happened in tech bubble burst. Our growth rate slowed down significantly with the rest of the world, but did not go into the negative. This is again our base case this time around as well. So global equities to continue the bear market that started in 2022. It's still early days. We believe the bear market could go on for at least maybe another 2 to 3 years. And key global equity indices would lose 20 to 30% from the current levels, guys. This is not from the top, but from the current levels. So I think another 20 to 30% fall can be expected over the next 3 years. Indian equities will also probably deliver negative returns for the next 3 years, but maybe lesser so than most parts of the world. So India is still looking like it is better placed than most parts of the world, particularly better than US, better than Europe, and even better than China. But Indian equities are also going to probably deliver negative returns. Gold is going to go a lot higher, but it has gone up too much in the last 6-7 months. So it's probably going to be sideways for an extended period of time. And after consolidating and being sideways, it will probably again take off and then move on much, much higher is what I meant. And long duration government bonds all over the world are going to give a very handsome return over the next 2 to 3 years. And we believe that US 30-year treasury yields are going to go down a lot, which means the US long-term bonds are going to deliver a very handsome return over the next 2 to 3 years. They have been a complete disaster in the last 2 years, but you would see that trend changing. In fact, it has already changed. You would see them delivering very, very good returns over the next 2 to 3 years. So thank you so much for your time and attention, everybody. And we've come to the end of the presentation, and now we are open for the Q&A.
Sure, Amit. I think this was a very unusual presentation, if I may call it like that. We are used to hearing bullish views, and we have kind of been firmly believing in golden decade ahead of us. And in line with that, I think investors have that optimistic opinion. But after kind of going through your presentation, which also does talk a lot of facts, it kind of makes an investor believe that maybe he needs to balance his portfolio with better asset allocation. So my first question to you is that how has your strategy actually practically performed over years, and especially during the kind of downtrends? Because I have not seen any, or I would say, any popular macro driven or a top down driven strategy which actually was able to predict scenarios like global financial crisis or something like COVID outbreak, and was able to sit on cash. Or in fact, I can tell you those strategies which try to sit on cash during COVID period could not enter again in the month of April, May of 2020, and were actually late. So the learnings over years for most investors has been that if you are able to identify a good business like Bajaj Finance and hold it for a decade, you can make maybe 50-60 times return. Can such returns be actually practically be made in following a macro top down approach, is the question. And practically, have your portfolio been making such returns? Please kind of give us those practical replies.
Thank you so much, Kamal. So at the outset, I am not pessimistic on India. So I'm not saying that it's going to be gloom and doom in India. All that I'm going to be saying is that we still have, as a country, we'll probably march ahead and we'll still go a lot further from here. It's just that this maybe instead of starting in the right earnest now, maybe is postponed by a few years because of the global macro backdrop. That's all that I'm saying. So I'm not saying that this is not going to be India's century. All that I'm saying is that the next 3 years are looking extremely tough globally. And whenever that has happened in the past, India has slowed down and Indian markets have also suffered. But whoever catches that bottom point over the next 2 to 3 years will probably go all the way laughing to the bank, because Indian markets are going to outperform every other market. That's my conviction. But next 2 to 3 years are tough. So I'm going to be extremely, extremely reserved in, and I'm going to be extremely conservative in my asset allocation. Number one. Number second, macro top-down strategies for us and our clients have delivered amazing returns. So we were zero on equities pre-COVID, not because we knew that COVID is going to strike and it's going to paralyze the whole world, but because the valuations were way too rich for our comfort. So we were practically sitting on zero equities pre-COVID. And because of that, because we were zero on equities, we were able to latch onto equities in a very big way in March and April, which I thought was, an opportunity of a lifetime. So we went completely long on equities that time. So similarly, during the GFC 2008, we delivered a double-digit return. While the whole world was negative 50%, but we delivered double-digit returns in 2008. We delivered double-digit returns in 2001. So this is the beauty of macro top-down, that you are able to make money across bull and bear markets. Of course, I would want to give a small caveat here, that when the bull market is in its last stages, when there is overvaluation, but there is so much of momentum in the market that the market still keep going up and up and up, that's the time when a macro top-down player like us may underperform, because we would start cashing out not at the absolutely at the top, because nobody can time the top. But when we become very uncomfortable with valuations, we would keep taking money off the table. So maybe in the last 6 months of every bull run, you would expect us to underperform. But during bear markets, sideways market, volatile market, low uptrending market, or even in the normal bull run, you would probably have a macro top down outperform rest of the guys. Maybe the outperformance is more stark during bear markets, it's more stark in sideways and volatile markets, but it is less stark in a bull market. But last 6 months of every bull run, we would underperform. This happened with us in 2021 when we were tearing ahead, and this has happened in the past as well. But if you look at any 10-year period, we would probably generate an alpha over our peers. So we would not just generate an alpha over the benchmark, but we would outperform our micro bottoms up peers. And on a risk adjusted basis, we would be even much higher because we would not deliver you any year of negative return. Now, your question, likes of Bajaj Finance, people made 50 times their money. Probably a macro top down guy would not make 50 times the money in a Bajaj Finance. But please do remember that for every one hit or five super hits which a micro bottoms up guy would have, they would also have stocks which would go down or which would not do anything at all. So what is important is not the returns that you made in one stock, but the returns that you made at the portfolio level. And there I can assure you that macro top down has delivered better returns in the past, and particularly the next 5 to 10 years, as the markets have become more macro, and the next 3 to 4 years, when the markets are expected to be sideways to bearish, macro top down is going to deliver a much, much higher return than the micro bottoms up peers.
Sure, Amit. I think this is a very interesting, I would say knowledge webinar going on for all of us. Provides us a balancing perspective. So I would want to know, and I'm really curious and keen to know what's the strategy of your, asset allocation oriented approach at the moment in the current context of, where valuations on equities on trailing basis looking attractive, on forward look basis looking attractive. We are almost, I would say, at a similar level as we were at the bottom of COVID. At a peak of COVID, I would say during March of 2020, the Nifty PE was around 2021. We are at the same PE now. And obviously interest rate cycle also seems to have kind of reached its peak. So, and earnings, in the Indian context, at least, I can say looks to be at all time high. So when all these factors are like looking positive, but global factors are looking uncertain, what is the strategy? What is the asset allocation strategy that you are following?
So please do bear in mind that no bear market in India or globally has bottomed out in the last 50 years without the central banks cutting rates. It has not happened in the last 100 years, and it's not going to happen this time as well. All the central banks, they have been taking up the rates. The market bottom is going to be not when the interest rates are at the top, but the market bottom is always made when the interest rates are at their bottom. So we believe that the interest rate cycle is topping out. It's going to come down over the next 2 years, 3 years, and the bear market bottoms and the economic bottoms are going to be made when the interest rate cycle is close to its bottom. That is one. Secondly, we believe that the global macro backdrop is very negative for the overall global economy and even for the developing markets like India. So the next 3 years are looking somewhat bleak. I'm not saying that there is going to be gloom and doom, but I'm saying that there is time to be cautious as far as your business decisions are concerned and as far as your investment decisions are concerned. As far as our current allocation is concerned, in January, we were zero on Indian equities because the valuations were way too high. Then the Adani Hindenburg crisis hit the markets. We started buying equities, and in March, we had a very high allocation. In fact, we had the highest allocation to equities that we've had in the last 1.5 years. And we have been taking advantage of the rise in the markets in the last few days and weeks to take our money off the table. So right now, our equity percentage has come down compared to the highest that it was in the end of March 2023. So equity allocations have come down. Fixed income allocations are going up. Precious metals are stable. So we are at about 20% of the portfolio in precious metals. We are not very immediate term bullish on precious metals. We believe that they will now hit a sideways sort of a patch for the next many months. We are going to take the allocation in precious metals up when we believe that the sideways consolidation is over. And in equity markets, we are going to be buying every time there is going to be a panic like there was in March. And every time there is a euphoria like there is right now, we would be selling. So we would do this every 2, 3, 4 months. In the last 1.5 years, there have been opportunities to buy and there have been opportunities to sell. We will keep taking advantage of those opportunities, which is why we are the top performing AIF, one of the top performing AIFs and PMS in the country. Because while everybody else is saddled with stocks at high valuations, we have been taking advantage of these opportunities to get into the market and then get out of the market. So this is what my current allocation is.
Sure, Amit. So, you mentioned that markets would bottom out when RBI would actually be at the bottom of interest rates. So after, at the moment, obviously we are closer to peak of the interest rate scenario. But my learnings over years has been that market works on forward thinking, and equity markets, because in terms of valuations they're attractive now and interest rate cycle is at almost peak. The moment markets will realize that now the interest rate cycle is going to turn and maybe interest rates will gradually start to fall, market will start to react since, from then. By the time interest rates will be back to maybe 2-3% down from these levels, equity markets would have run up almost 20-25-30%. Wouldn't it be too late to realize then than realizing now?
That's a brilliant question, Kamal. And I know that many of our investors are sort of grappling with this conundrum. But I have a very clear view on this. Markets are absolutely forward looking, which is why the global equity markets bottomed out in October of 22 when the bond yields globally were close to their multi-decade highs, guys, multi-year highs, and in some cases multi-decade highs. That's when the equity markets bottomed out. So you need to look at this last 7 month bull run as the market's response to the expectation of topping out of the interest rates and inflation. There is no way that you can explain the rally of the last 6 to 7 months. S&P 500 has rallied from 3,500 to 4,200. Indian markets have also rallied, of course, not as much, but look at UK, look at Europe. All this rally is a function of that expectation, and that rally, in my opinion, is 90% over. There could be leftover 10% of that rally, which may happen over the next few days. I do not see the market very sustainable at the current levels, and the markets being forward looking will start coming down because just like the markets foresaw 7 months back that the interest rates and inflation problem is peaking out. Similarly, the markets are now figuring out that the scenario is too rosy and the actual unfolding is not going to be similar to what the scenario is being painted. The markets will probably start falling, and then you would have a recession sometime in the next 1 year. Markets being forward looking will start discounting the recession. Central banks over the next 6 months will start taking down the interest rates. But because the overall economic cycle is going to be down, even after interest rate cuts, the markets are not going to recover. But eventually, the markets will recover about 3 years down the line when the markets will figure out that the rates have now come down sufficiently and all the negativity and all the excess debt has been washed off. And now is the time to rally. I believe what you are suggesting is going to happen, but the year for that to happen is probably 2025-26 and not CY 2023.
Right, Amit. Okay. So, see, the thing is, what you have mentioned in terms of though markets being forward looking and markets currently in that, phase where since October of 2022, markets have already kind of started to gradually show outperformance, be it China, be it UK, be it US. But if I practically see portfolios of investors, I myself investor, we have more than 500 clients, and most of those clients which are equity exposed, October till now their values of portfolios have not gone up. Though, the thing is, either they are at the same level or maybe they are up 1-2-3%, or they are down 5-7%. This is the same story across all portfolios, be it value portfolios or growth portfolios or growth at reasonable value portfolios, or even somehow, the portfolios which are like asset allocation oriented portfolios. Because obviously, the asset allocation oriented portfolios also took call of getting in long term bonds much early, and interest rate actually went up, right? So they have also been kind of wrong in timing that part. But yes, I agree with you that US markets and China markets and UK markets have rallied. So I want you to kind of focus on the Indian investor, because the audience currently that we are talking to is a audience which is having exposure to Indian bonds and Indian equities. and from their point of view, they have not seen their value, the prices of their portfolios going up over last 6 8 months, and actually they have been waiting for market to kind of again show good times since last more than 22 months. And when you say that the good times are going to come back after 2024, which means 2 more years of, I would say, waiting time or a pain. This is something which seems to be unbelievable, because that will make valuations kind of too attractive, in the sense that today the forward P of Nifty 50 is around 15, 16, 17. If we have to wait 2 more years, then forward P will be less than 10. So that this kind of makes me at least unable to digest, because maybe probably I am a bullish investor. Hence, I am asking this question again and want you to focus in this context and try to address this perspective.
I think that's again a brilliant question. So, Kamal, if you look at the Indian context now, and now I'm going to talk purely about the Indian context. So, our markets in the short term often deviate from the global markets. So, in October, we were still, when the whole world was crashing down, Nifty was still around 17,000, and our stocks were still not doing so badly. We actually peaked out in December 22. Nifty peaked out in December 22 when the rest of the world was crashing down. So in the short term, our cycles can deviate from the global landscape. But if you look at what happened in June 2022, we were at 15,000 on Nifty. And from 15,000 levels, today we are at 18,000 plus levels. So from June 22 to April 23, in 10 months, we have actually gone up by 20% on Nifty, and similarly small cap and mid caps have also done very well. But yes, if you look at purely October to April performance, then we have not done so well because our cycle deviated from the global cycle. This is one. Second, you have raised a very important point on the forward P ratios. So, the projections which analysts have from the Indian corporate world and from the Indian stocks is way too high. So I do not believe that you would see the kind of growth rate, the 15-20% growth rate in bottom line, which those people are forecasting. I do not see that happening, number one. Number second, in any recession, in every recession that has happened globally, not in India. So in every global recession, Indian bottom lines have come down. So please do not look at the current EPS as the base EPS, which can only go up from here. In every global recession, even though we have, in terms of GDP, India does not go negative, but yes, our corporate bottom lines come down because of the fact that the margins come down when there is a global recession. All the money which the steel makers and all these commodity producers, that how crashing the commodities come down when there is a global recession. So similarly, the entire corporate world, whether it is IT or so many other sectors, they suffer from lack of profit margins. So the EPS base will also come down if there is a global recession. This is one. Second, the projections of this year are way too rosy. So in my opinion, we are not at 17 or 16 forward P. We are right now probably at 18 forward P if you look at my earning projections. Lastly, even 18 forward P is too expensive for any equity market to bottom out. In India, when GFC happened, we bottomed out at 10 or 11. And similarly, in COVID, of course, we bottomed out at 17. But if you look at the tech bubble burst of 2001 and 2, we again came down to 11 or 12. So in my opinion, the fall in the Indian equity market is going to be broken down into three parameters. One, the growth rate of EPS is going to come down immediately. One. Second, eventually when the global recession strikes, our absolute EPS are going to come down. And third, the P ratios are going to come down. If you include these three factors, guys, then howsoever maths you want to run on these numbers, you would see that the 2024-25 projection on Nifty is not going to be 18,000. In my opinion, we are looking at sub 15,000. It could be 14, it could be 13. But we have calculated all these estimates based on entire global backdrop, based on our own history of the Indian corporate world and Indian economy and Indian markets. And this is what we come down to. the EPS numbers are going to come down, the P ratios are going to come down, and overall, the markets are going to come down maybe about 15 to 20% at least.
Right, Amit. I think 1 hour is too less a time for a fund manager like you because you have a global experience. I have many more questions to be asked, but I don't think we can cover in this one session. We'll have to do maybe a couple of more webinars because the wisdom and the idea that you bring for clients is definitely unique, and I myself have learned a lot. So we will maybe soon end this webinar, but before we come to an end, I will ask one last question. This is maybe an objective question. What is your, I would say, projection of maybe levels of Sensex or Nifty by the end of this financial year? We are the first month. We just ended the first month of this financial year. So if you have to give your projections, maybe I do not know, when those levels come, it may be within the year or after the year, but over say next 12 to 18 months.
Yeah. So as far as the CY 2023 is concerned, probably somewhere between 15,500 to 16,500. If you talk about the next 12 to 18 months, which is the end of CY24, let's say, then I think we are probably looking at below 15,000. I think my base case would be about 14,000, give or take a few percentage points. But the global recession is now just around the corner, guys, and things are going to move fast. It often happens that when the bull cycle tops out, the world does not go into a recession immediately. This has happened many, many times in the past, and it's probably going to happen now that the markets have peaked out, but the global slowdown and global recession is probably going to unfold in the next 1 to 1.5 years. Markets being forward looking should probably start coming down within the next 2 to 3 months. And I think somewhere around 2025, probably you would see the actual bottoming out of the markets. But I still believe that on a very, very long term basis, we need to be optimistic on India. I think as a global asset manager, I'm going to be optimistic, and I would take advantage of this global recession to take my weightages on Indian stocks maybe a lot higher than it has ever been in the last many years. And I look forward to the unfolding of the Indian century after that.
Right. Thank you so much, Amit. I think, if I was to sum it up, I would say that next 1 year looks to be kind of quite optimistic in terms of throwing a lot of opportunity for investors to add more to asset allocation. But since, markets are not, I would say, running in aloof, we are living in a global world. And since the Western world is going in recession, obviously Indian investors need to be cognizant of the same. And we may not just be emotional about, India being our country land and invested in Indian equities, because if global market kind of again goes down, it will definitely drag Indian equities as well. And hence, asset allocation is an important aspect, and that is exactly what you bring. It will be interesting to know, what does Pace 360 PMS offer to investors if investors were to give you, their 50 lakhs now. It's a, I would say, elaborate subject. We cannot cover that over, I think, in maybe 1 or 2 questions. So I would urge you to plan another webinar where we'll particularly focus on, how Indian investors will actually benefit by giving and handing over money to you over say next 1 year. Thank you so much, for your time, Amit, for this webinar. Thank you everyone for joining us today. We'll again meet next Friday. Thank you once again.
Thank you, Kamal. Thank you, everybody. Thank you for your time, attention, and energies. Thank you so much.
Pleasure.